Well, it is a new month, and on Wall Street, day one was a good one for stocks. The markets got a big boost from a surprisingly strong read on U.S. manufacturing in October. It rose at the fastest pace in 2.5 years. Also, a strong read on factory activity in China. All the major averages avoiding a third consecutive day of losses, with stocks rising into the close. The Dow up nearly 70 points. NASDAQ added 2. The S&P 500 was up 5. Rates on the 10-year Treasury note, well, they rose steadily all session long, closed up at 2.6%.
A top Federal Reserve official said today it's time for the central bank to phase out its stimulus program. Charles Plosser, president of the Philadelphia Federal Reserve Bank, said the Fed should have begun tapering back at its meeting earlier this week.
I thought we kind of missed an opportunity to make a small gesture to begin signaling that, in fact, this is a dial we can move and we can adjust it and fine-tune it, if you will.
Plosser also suggested setting a maximum dollar amount for the Fed's bond buying program instead of sticking to the target of the U.S. unemployment rate getting down to 6.5%.
And in addition to the Fed's stimulus this year, one of the factors that has helped stock prices in 2013 is a rash of buybacks. Companies using their cash reserves to snap up their own shares. That reduces the supply of stock and lifts the profit per share. Dominic Chu has the story.
Corporate profits and the stock market are at record highs, but one measure of a company's financial success may be a bit more complicated to explain. That's earnings per share.
If you have $100 in profits and 100 shares outstanding, but you buy back half of them, your earnings per share will go to $2. So you can double your earnings per share, a key stock market measure, without actually growing your profits. It's one way to grow earnings per share. It is not a way to grow corporate profits.
Miller Tabak's chief economic strategist, Andrew Wilkinson, took a look at a handful of companies with larger share buyback programs to look at how earnings per share were affected. Take business software giant Oracle. Wilkinson estimates that its earnings per share were about 9% better this past quarter simply because of having fewer shares outstanding. Global casino giant Wynn Resorts got an estimated 23% improvement. And satellite TV provider DirecTV got an estimated 47% improvement. Nuveen Asset Management's chief equity strategist Bob Dahl said the effects of share buybacks are important.
Most estimates say that 2 to 3% of the earnings growth we've seen is from buybacks, the shrinkage of shares. So it's not inconsequential.
Generally speaking, companies that buy back their own shares have outperformed the broader market. Since the end of 1999, Wilkinson notes that the S&P 500 buyback index is up 250%. That's versus the 20% rise in the S&P 500. There's even an exchange-traded fund that tracks companies that engage in bigger stock buyback programs. The PowerShares Buyback Achievers, ticker PKW. So that's one place to look if you believe or don't believe the stock buyback story. For Nightly Business Report, I'm Dominic Chu.
Tim Courtney is a believer in stock buybacks. He's Chief Investment Officer at Exensio Wealth Advisors. Tim, welcome to Nightly Business Report. Let me begin by just asking you, sort of get into the debate about stock buybacks. You know, some people would say a stock buyback is basically you're playing with the numbers. It's financial engineering, and that it would be better if a company used that money to grow the business, to develop new products. What do you say to that?
Well, I think, for one, I think the market is pretty good at seeing through that. It is pretty transparent, and it's hard to hide the fact that you are increasing earnings per share by doing share buybacks. So I think the market does a pretty good job of pricing the stocks and seeing through that. But I think another reason why companies would do that, besides maybe trying to make the numbers look better, is because maybe they don't feel like they have enough confidence in the economy, or maybe there are legislative risks to go take cash and go do a large-scale research and development project. They'd be better off taking that cash and going and buying back stock.
You know, you saw some of the numbers that were in Dominic's piece there. If I'm trying to choose between two companies relatively comparable in many ways, and one is buying back its shares, the other is not, should I choose the one that's buying back its shares?
Well, I think it depends, although that's a good sign. If the company is looking at its prospects and has excess cash and is putting that cash to work back into buying stock, I think that's a mark in its favor. All other things being equal, you would want to see that, certainly.
But not all buybacks are beneficial. It doesn't always work out that way, right?
That's right. I mean, there are some studies that show that companies that have lower profitability, when they do invest in themselves, they tend to have lower returns. And there are some examples of some stocks recently that have shown that same phenomenon. So it tends to be the companies that it works best for are companies with higher profitability, where they're taking free cash and putting that to work, buying back their shares. Not so good for companies who are struggling with profitability.
Do any of those companies that you just mentioned, did any come to mind? Name them.
Well, there was an article yesterday from the Wall Street Journal talking about IBM and how IBM's price really has not moved in the last couple of years, and primarily it's because IBM is having some trouble generating revenue growth. So I think that's a good example of a company that's doing share buybacks, but it's not affecting the price. And again, that goes back to the market being pretty effective at determining what's causing these earnings per share increases and not just adding value onto the stock because they're buying back shares.
So, Tim, what is the trend now for buybacks? This year was a big year for buybacks. It seemed like every company was announcing some kind of buyback program. Has the trend run its course?
It looks like it's going to continue because earnings are still growing. Companies, it looks like in the third quarter, profits will set a new quarterly record. And so there's going to be a lot of cash on the company's balance sheets, and that is probably going to tend to indicate that these buybacks will continue and probably into 2014 increase.
Let me throw a little curveball at you. Some companies, like Apple, are being urged to go out and borrow money to do a stock buyback, not to use their cash, in Apple's case, because they have to bring it back from overseas and pay tax on it. Does that tell you anything, if they're borrowing to buy it?
Yeah, I've seen that a lot, and I think the math shows that can make sense, and I think, again, that's an issue with the tax code. I don't necessarily agree with some of the tax policies that we have for repatriating of cash, but with those tax costs to bring in the money back into the United States, it certainly can make sense to borrow and buy back.
All right, well, we're going to leave it there. Thank you so much for all your thoughts. Tim Courtney, Chief Investment Officer at Exensio Wealth Advisors.